Hello, everyone. I am Roldán Ferrer. For over 25 years, I have navigated the complexities of the global financial markets, from the dot-com bubble and the 2008 crash to the digital transformation of the early 2020s. Today, we face a geopolitical landscape that many feared, but few truly prepared for: an intensified conflict between the Israel-US alliance and Iran. In times of war, emotions run high, and headlines are designed to spark panic. But the market follows the cold, hard logic of supply, demand, and risk. Over the next 8 minutes, I am going to show you how to protect your capital and identify the specific asset classes that historically thrive when the geopolitical map catches fire. This is not about speculation. It is about strategic allocation based on decades of market observation. We must look past the chaos of the 24-hour news cycle and understand where the institutional money is moving, because in my experience, the smart money is already positioned before the first missile is even launched. The first and most immediate impact of a conflict involving Iran is always found in the energy sector, but we must look deeper than just the price of a barrel. We must understand that Iran sits at the gateway of the Strait of Hormuz, a choke point through which nearly 20% of the world's oil passes daily. Any disruption there sends shockwaves through the energy markets that can last for months. If you are looking for a hedge, you need to focus on upstream oil producers with heavy footprints in the United States, Canada, or South America. Companies like Occidental Petroleum or Chevron are shielded from the physical combat zone but benefit directly from the inevitable price surge in Brent and WTI crude. Furthermore, do not ignore natural gas. As Middle Eastern supply becomes uncertain and shipping lanes in the Gulf become high-risk zones, the world, especially Europe, leans even harder on U.S. LNG exports. This makes infrastructure plays and exporters like Cheniere Energy or New Fortress Energy essential components of a wartime portfolio. We are looking at a scenario where energy is used as a geopolitical weapon. And as an investor, your goal is to be on the side of the suppliers who remain operational during the crisis. Moving beyond energy, we must look at the defense sector, which in 2026 has evolved into a high-tech industry driven by AI and autonomous systems. War is no longer just about boots on the ground. It is about technological and electronic superiority. The defense giants like Lockheed Martin and RTX Corporation remain the backbone of missile defense systems like the Iron Dome and the Aegis system, and their order backlogs are currently at record highs due to global rearmament. Companies like Palantir, which provide AI-driven battlefield analytics and predictive targeting, become indispensable in modern warfare, where data is as valuable as ammunition. Simultaneously, we must consider cybersecurity as a primary front. Iran's primary asymmetric weapon is cyber warfare, targeting financial institutions and power grids. This means that as physical tensions rise, the demand for protection from companies like CrowdStrike, Palo Alto Networks, and Fortinet will only accelerate. These aren't just stocks, they are the digital walls of modern civilization, and their importance only grows during times of state-sponsored conflict. When the cannons fire, the global investment community instinctively runs towards safety. But safety in the current economy requires a nuanced approach that goes beyond just burying cash.
Gold remains the ultimate store of value because it has no counterparty risk and acts as a perfect insurance policy against the currency debasement that war typically triggers. In a scenario where the U.S. is actively involved in a conflict, gold often hits record highs as investors flee fiat volatility and hedge against the massive government spending required for military operations. However, don't ignore the U.S. dollar. Despite the geopolitical tension, the dollar remains the global reserve. In the initial phase of any conflict, we see a flight to quality where the DXY index spikes as capital is pulled out of riskier emerging markets and parked in U.S. treasuries or cash.
My advice is to maintain a balance: gold for long-term protection and the dollar for immediate liquidity and purchasing power when other assets are crashing. During the first 48 to 72 hours of a major conflict, there is usually a wave of blind panic selling that affects even the healthiest companies. High-quality big tech firms, the Apples, Microsofts, and Nvidias of the world, often see their stock prices dragged down by general market fear rather than a change in their fundamental value or earning potential. This is where you must use your dry powder or cash reserves. History shows that markets typically recover from geopolitical shocks within 3 to 6 months once the initial uncertainty is priced in. If you see a world-class company drop 10% or 15% purely due to geopolitical noise, my experience tells me that is not a crisis. It is a generational entry point for the disciplined investor who can look past the next week and into the next year. You are buying the world's most productive assets at a discount, provided by those who are acting on fear. We must also consider the logistics pivot that occurs when traditional trade routes are threatened. If the Middle East becomes a high-risk zone for maritime insurance, global trade routes are forced to reroute, often increasing the importance of Western ports, rail networks, and air freight. Companies that dominate North American logistics, such as Union Pacific, or major shipping conglomerates that operate primarily in the Atlantic or Pacific lanes, can actually see increased margins due to higher freight rates and diverted traffic. This is a subtle play that many retail investors miss, but it is one that institutional money has used for decades to maintain profitability during times of regional instability. Furthermore, look at the semiconductor industry. A conflict in the Middle East often reminds the world of the fragility of global supply chains, leading to renewed investment in domestic chip manufacturing, like Intel or Texas Instruments, which are far removed from the immediate conflict zone, but vital for the defense and tech industries.
Success in this high-stakes environment requires a strict adherence to risk management that most people simply don't have the stomach for. You must ensure your portfolio is diversified across energy, defense, and hard assets. But above all, you must maintain a level of liquidity that allows you to be opportunistic. I have seen many investors ruin their long-term wealth by being 100% invested and having no cash to act when a true flash crash occurs. You should never try to predict the winner of a war. Instead, your job is to predict the flow of capital and the reaction of central banks. Will the Federal Reserve pause rate hikes to support the economy during wartime? Will inflation spike due to oil prices? These are the questions an expert investor asks. The goal is to remain clinical and detached from the headlines.
If you allow the tragedy of war to dictate your trades emotionally, you have already lost the battle for your financial future. In conclusion, managing wealth during a global conflict requires a steady hand, a lack of ego, and a long-term perspective that spans years, not days. The strategies I have shared today are based on the reality that, while the world changes, the mechanisms of the market remain remarkably consistent in their response to fear and scarcity. Protect your downside with gold and energy, capture the growth in defense and cybertech, and be ready to buy the dip in high-quality equities when the rest of the world is panicking. I am Roldán Ferrer, and throughout my 25 years in this sector, I have learned that the best defense is a well-positioned offense. Stay informed, stay disciplined, and remember that in the world of finance, knowledge and emotional control are the only assets that never lose their value. Thank you for watching, and I will see you in the next analysis where we will continue to break down the world's most complex market movements.